Now it's my pleasure to start off with our next keynote speaker and make the introduction. We're delighted to have Bill Coen, the Secretary General of the Basel Committee, as our first keynote speaker at the AGM. Bill has become Secretary General in 2014, and he served as Deputy Secretary for 7 years prior to that. And he has played such a critical role in the finalization of the Basel III reforms. He has been working with other regulators and the industry to produce a framework that is appropriately risk-sensitive and that recognizes the complexity of our market. Please join me in welcoming Bill Coen to the stage.
Good morning. Thanks, Scott, and thanks to ISDA for inviting me here. I missed a good time last night, I hear. I was pleased to be here, though, because there's no shortage of supervisory regulatory things to discuss. As you could guess, for me, closest to home is full, timely, consistent implementation of the recently finalized post-crisis regulatory reforms, most notably the Basel III framework. So this morning I'd like to focus on just one element of that is particularly interesting because one of the hats I wear in Basel, besides Secretary General, I chair a group called the Policy Development Group. So everything the Basel Committee's done on credit risk, operational risk, any risk measurement or risk management issue comes through the Policy Development Group. So while we've done a lot over the course of the last 10 years, the one thing we're still working on, that of course is market risk. So first, let me give you a little bit of perspective. 10 years have passed since the start of the global financial crisis, and during that period, the committee's finalized its wide-ranging, its comprehensive set of post-crisis reforms. And you know all about these. They greatly improve quality of regulatory capital, they increase capital requirements, enhance risk capture, while specifying a minimum leverage ratio requirement, adding a macro-prudential overlay, and introducing international liquidity standards. But there's one element, of course, of the post-crisis reform agenda that's yet to be fully finalized, and that's the market risk framework. Let me share with you an excerpt from a Basel Committee document. Here's what it said. A common response has been that the frameworks developed by the committee for measuring market risk are at the same time complex and inaccurate. The frameworks are further criticized for incorporating a methodology which banks do not use. Maybe this sounds familiar, but it might surprise you that this excerpt is from a 1994 Basel Committee document summarizing comments that we received on a 1993 consultative paper on the prudential supervision of netting, market risk, and interest rate risk. So now I've got a few slides, and I wonder if we can get them up on the screen for me, please. Thank you. So here we are, a full quarter century later. And I wonder, must we lament the finalization of the market risk framework as one of those never-ending stories? My remarks today will try to answer three questions. First, why has the committee revised the market risk framework? Second, why has it taken so long to complete? And third, how do we get the framework finished in a timely manner? Let me turn to the first question. Why revise the market risk framework? Trading book instruments have existed for centuries, perhaps even millennia. Some say the 48th law in Hammurabi's code makes the first reference to them under this Babylonian legislation, which dates from around 1754 BC. Farmers could renege on their debt if their crops failed. This is much akin to a put option. In the event of a poor harvest, the farmer could exercise his right to stop making debt payments. Similarly, but somewhat later, Aristotle recounts the story of the Greek philosopher Thales, who expected an unusually large olive harvest and secured the right, but not the obligation, to use all the olive presses in the ancient Greek city of Miletus for the following year. Now, moving to the present day, the global financial crisis exposed fault lines in the Basel II market risk framework. The framework's low capital requirement for market risk was far eclipsed by the market risk losses of many banks. As a stopgap response, the committee introduced a set of revisions. the Basel 2.5 framework. We didn't give it that name, by the way. That's an industry construct. I would have thought of something maybe a little more clever than Basel 2.5, but here we are. So Basel 2.5 sought to reduce the framework cyclicality and enhance the overall level of capital. There was a particular focus on instruments exposed to credit risk, including securitization, where the previous regime had been found especially lacking. However, the committee recognized at the time that Basel 2.5 didn't fully address the framework's shortcomings, and as a result, we conducted a fundamental review of the trading book regime and consulted in 2012 on measures to improve trading book capital requirements. The review sought to address shortcomings in the regime's design, as well as weaknesses in risk measurement under both the internal models-based and the standardized approaches. Let me just remind you of what some of those changes were. First, the trading book, banking book boundary. One source of weakness in the pre-crisis regime was how the regulatory boundary was defined. A key determinant was whether banks intended to trade, but this was inherently a subjective criterion that proved difficult to police and insufficiently restrictive, at least from a prudential perspective. Coupled with large differences in capital requirements against similar types of risk on either side of the boundary, the overall capital framework proved susceptible to arbitrage. The second objective of the FRTB was to incorporate the risk of market illiquidity. Before the Basel 2.5 changes were introduced, the market risk framework rested on the assumption that trading book risk positions were liquid. That is, that banks could exit or hedge these positions over a 10-day horizon. This assumption didn't survive the global financial crisis. As liquidity then drained away, banks were left holding risk positions for much longer than originally expected, taking large hits when liquidity premia and market prices fluctuated. Next, the FRTB enhanced the robustness and risk sensitivity of the standardized approach. By peak crisis, most stakeholders had lost faith in the risk-weighted capital ratios that banks were reporting. The committee was increasingly worried about the excessive variability in banks' calculations of risk-weighted assets, including for market risk. For example, based on the committee's assessment, the capital requirement modeled by banks for a set of hypothetical diversified portfolios varied by a factor of more than 3. The analysis showed that differences in modeling choices are a significant driver of variation in market risk-weighted assets across banks. And accordingly, the Basel III revisions require banks to calculate and disclose their market risk capital requirements based on a revised, standardized approach to enhance comparability across banks and jurisdictions. This approach will also be used in the calculation of the aggregate output floor requirement. A fourth objective of the FRTB was to capitalize against tail risk. The crisis also highlighted a number of weaknesses with the use of value at risk, VAR, to determine regulatory capital requirements, including VAR's inability to capture tail risk. Our move to using expected shortfall as the measure for determining regulatory market risk capital requirements is motivated by the importance of better capturing tail risk. So in short, the pre-crisis market risk framework was in need of major repair. However, the weaknesses exposed by the crisis were also a stark reminder of the shortcomings in banks' own risk management practices and the limitations of models in general. So what's taking so long to complete the market risk framework? After several years of work that included multiple consultations and quantitative impact studies, the committee published a revised standard for the market risk framework in January 2016. As part of finalizing the Basel III framework last year, ongoing challenges in implementing certain bank capital reforms were acknowledged by the group of central bank governors and heads of supervision. This is the group to which the Basel Committee reports, the GHAS, as we like to call them. So the GHAS is the Basel Committee's governing body. The GHAS endorsed the committee's proposal to extend the implementation date of the revised market risk framework from 2019 to January 2022. And this covers both the implementation and the first regulatory reporting date for the revised framework. Deferring implementation of the revised market risk framework will also align its starting date with those of the Basel III revisions related to credit risk and operational risk. It will give banks more time to develop the systems needed to apply the framework. It'll certainly give us, from the official sector, time for our part to get the supervisory mechanism in place as well. More recently, the committee issued a consultative paper in March proposing changes to the revised market risk framework. These include revisions to the calibration of certain elements of the standardized approach and to the assessment process that determines whether a bank's internal risk management models appropriately reflect the risks of individual trading desks. So there have been many developments related to the market risk framework, even after the publication of the revised standard in early 2016. I think a fair question you might ask is, where are we exactly in revising the market risk framework, and why is it taking so long to finalize? Let me offer three reflections. First, as I mentioned earlier, market risk is important. It was a major source of losses for banks during the global financial crisis, and episodes of market risk-related stress can often catalyze credit risk and liquidity risk concerns, and vice versa. Many of the activities captured in the trading book, such as market making and capital raising, help support the real economy. So it's important that the prudential regulatory framework for market risk is calibrated to ensure the safety and soundness of the banking system, and subject to achieving this objective, that it mitigates any unintended impacts on socially useful market activities. This is why the committee has repeatedly consulted on its revisions to the market risk framework over the past several years, and why it's been engaging closely with ISDA and other external stakeholders in finalizing the rules. Second, although market risk is significant for banks with large and complex trading portfolios, the revisions to the market risk framework may at times have suffered from an illusory quest for perfect risk sensitivity, resulting in a disproportionate use of the Basel Committee's time and that of external stakeholders. Consider the following facts. In aggregate, market risk accounts for the smallest share of total capital requirements across the main risk categories. This is the case both for relatively large, internationally active banks and for small ones. At the end of June 2017, market risk comprised less than 5% for the big banks, 2.5% for the smaller banks, and this is 5% and 2.5% of total minimum required capital. The share has only become smaller over time. Since the end of 2011, the share of market risk as a proportion of total minimum required capital is almost halved for the larger banks, including the global systemically important banks, the G-SIBs. As an interesting aside, the small contribution of market risk to overall capital requirements stands in stark contrast to the amount of resources devoted to the market risk framework. A simple, admittedly crude way of measuring the time and resources devoted to market risk is to calculate the ratio of the share of publications by the Basel Committee since 1980 on different risk categories, vis-a-vis the share of each risk category to total capital requirements. Suffice to say, we've issued about 6 times as many publications as one might expect from just looking at the share of market risk as a percentage of total capital requirements. And this ratio increases to 10 times if the ratio is based on the number of references in Basel Committee publications. Now, the capital impact of the revised market risk framework is small for almost all banks. Based on an earlier analysis by the committee prior to the finalization of the FRTB, the average change in market risk capital requirements resulting from the revised framework is about 5% of total capital requirements. These results don't reflect subsequent modifications issued in the revised framework upon its finalization, and that those further modifications serve to reduce the impact. At that time, there were a handful of, let's call them outliers, that would see a more significant increase or even a reduction of their market risk capital requirements. So faced with these facts, an open question I ask is whether the revised market risk framework has adequately balanced simplicity, comparability, and risk sensitivity. In the run-up last year to our completion of the Basel framework revisions in December, a common refrain that I heard quite often was the need to maintain risk sensitivity. There was a concern, I have to say misguided in my view, that the imposition of an output floor and the other measures under consideration by the Basel Committee would impair the framework's risk sensitivity. The committee has previously reaffirmed its support of a risk-based capital regime and its belief that it should remain at the core of the framework for banks, supported by liquidity and funding metrics as well as other measures such as the leverage ratio. The committee has also noted, however, that the pursuit of increased risk sensitivity has considerably increased the complexity of the capital adequacy framework in some areas, particularly the calculation methodology for risk-weighted assets. I worry that it's often assumed that increased risk sensitivity is a priority of the banking industry, and the pursuit of simplicity and comparability are goals of supervisors. But the financial crisis demonstrated quite clearly, I think, that if the risk-based regime is too opaque, market participants will simply stop using risk-based capital ratios to assess the health of banks. Let me put it another way. The more complex the risk-based capital regime becomes, other measures, such as the leverage ratio, will grow in importance as an indicator of bank strength. It seems then to me, it's in the interest of the banking industry itself to ensure that the regulatory regime is robust throughout the cycle and that it can be clearly understood by supervisors, banks, and market participants. The consequences of undue complexity can directly affect banks' own internal risk management as well. For example, a bank's board and senior management may find it challenging to fully understand the bank's underlying risk profile, and as a result, the key drivers of the capital framework, even though the public has a legitimate expectation that they have that ability. Undue regulatory complexity can therefore impair the ability of the board and senior management of a bank to ensure that the bank has adequate capital to support its risks. Also, the use of highly complex approaches can jeopardize sound internal risk management to the extent that bank management places excessive reliance on them. Risk management decisions based entirely on the output of complex quantitative analysis does not necessarily lead to effective and prudent decision-making. More complex frameworks increase, let's call it quant risk, whereby risk managers and supervisors effectively delegate key aspects of risk management and supervisory oversight to a limited number of quantitative analysts. Finally, compliance with an unduly complex regulatory framework absorbs a large amount of banks' resources, not to mention supervisory resources. While this may be manageable for larger institutions, it places a greater burden on other banks. In short, we know that the pre-crisis framework resulted in imprudently low capital requirements for market risk. We know that market risk represents a relatively small share of total capital requirements for most banks. And we know that the estimated impact of the revised framework appears to be relatively manageable for most banks. So have we placed too much emphasis on attaining perfect risk sensitivity at the expense of simplicity and comparability, not to mention the significant cost associated with development and implementation? All right, let me return to my attempt to answer the question of where we currently stand with revising the market risk rules. The first thing I mentioned was the importance of market risk and getting it right. Then I talked about trying to strike the right balance between simplicity, risk sensitivity, and comparability. This brings me to my third point, which is the importance of having a framework that can be realistically implemented by banks and jurisdictions. In postponing FRTB's implementation, GHOS members reaffirmed that they expect the framework's full timely, and consistent implementation. And to meet this expectation, the framework needs to be designed in a way that can be implemented by internationally active banks and adequately overseen by supervisors. So while there may be sound conceptual reasons for pursuing a specific approach or making a particular revision to the market risk framework, it's in no one's interest to end up with a framework that can't be adequately implemented. Now, the committee's experience with its market risk quantitative impact studies is telling. We've conducted many quantitative exercises on market risk, both before and after the publication of the market risk framework, And this includes 2 risk-weighted asset variability studies and twice-yearly capital monitoring data collections. There's also a QIS that's currently underway. While the quality of data submitted by banks has improved over time, data quality concerns remain. Thus, a significant proportion of banks' data has been excluded from our analysis. These deficiencies may simply reflect the gradual adjustment of banks' systems to the revised framework. But as a result, the committee has, in some areas, been left with a small sample of banks to finalize certain outstanding revisions. This points to the importance of banks providing complete and robust trading book data submissions for the current QIS exercises, as well as providing concrete evidence to the questions posed in the consultative document that we published last month. This will facilitate the standards finalization. And those questions relate to the treatment of FX risk, trading seasonality as part of the non-modelable risk framework, and idiosyncratic equity risk. All right, so where does that leave us? 25 years since the committee's initial consultation on market risk, and I'll make 3 concluding remarks. First, the revised market framework represents a major improvement to the pre-crisis regulatory framework. The new one will address many of the fault lines exposed by the global financial crisis, and the main elements of the revised framework finalized in 2016 are in stable shape. And the committee is focused on finalizing the few remaining outstanding issues in a timely manner this year. Second, as we finish our work on the market risk framework, an important consideration for the committee and me personally is whether the framework adequately balances simplicity, comparability, and risk sensitivity. Will the committee need to consider whether simpler and more robust approaches should be included in the revised market risk framework? This is an open question at this stage, but it's one which I encourage all stakeholders to take into account. Third, there's a clear expectation for full, timely, and consistent implementation of all the Basel standards. This includes the January 2022 implementation date of the market risk framework, as reaffirmed last month by the G20 finance ministers and the central bank governors. So the committee will increasingly be focused on meeting this expectation. So in concluding, I'll make one more reference to Hammurabi's code. Law 233 of that ancient regulatory authority provides that if a builder builds a house for someone, and if then the walls seem to topple, the builder must make the walls solid from his own means. Now, in anticipation of an intensive and constructive dialogue between all stakeholders, I believe we have a unique opportunity to put the market risk framework on a solid footing. Now, I'd like to take this opportunity to express the committee's gratitude, my gratitude, to ISDA, Scott's team, Mark Panayotis, and others who are making a contribution, and to all the others here in this room who provide QIS data, who participate in a lot of our studies, for helping us to build this framework solidly. So thank you very much again for the invitation. Thank you for listening to me. I'm here for the next couple of days. ISDA's put together a fantastic program, and I look forward to speaking with you in the margins of the program. Thanks again.